Ladies and gentlemen, good afternoon and a very warm welcome to another edition of Navigate with HSBC. Um, Today we have the privilege of getting into a very interesting conversation with a leader of the investment industry, someone who many of us really look up to. I am privileged to welcome on this call Radhika Gupta, CEO of Edelweiss Asset Management. Radhika, welcome and thank you for giving time.
Thank you. It's always nice to talk to my friends at HSBC and also the customers here. I've interacted with some of you in physical formats, virtual formats. So it's always nice to be back here, and happy Friday, everyone.
Super. Radhika, obviously we'll keep this a free-flowing conversation. So I'll start by the obvious question. Beginning of this year, huge amount of uncertainty. Absolutely nobody had which way things are going. Not too much has changed, frankly. I think every day is a new decision being taken. So give us a bit of sense of what's happening to the world around us.
So I think the year feels uncertain, although uncertainty is not, uncommon to markets, because I think for a long time, maybe 3 years after COVID, we dealt with a world where uncertainty in general was very low. Um, and perhaps that also corrupts expectations. Now, 2024, I think in itself, the backdrop of the year that we came into was a very complex year where there were political regime changes in three major countries: India, because we moved to a coalition government, UK, and of course the US, which we talk about. There were economic changes and policies that economies like Japan and China had that changed directions. And then there was geopolitical bubbling. And that continued to carry over into 2025. So I think the world map in 2024 looks extraordinarily volatile, and we carried that over into 2025. Now, if we look at 2025, I think it's been plagued by two effects that we should talk about, and then we should talk about how things look in the future. One is global, and the second is domestic. I think domestically, you would say in 2025, and Q1 earnings also suggested that there has been some slowdown. If last year's we started by going into the year with an earnings estimate of 12-13%, we ended the year with 3-4%, which is, less than expectations for sure. And Q1 seems to be tricky. Our belief at Edelweiss Mutual Fund is that there are a number of steps the government is taking. One in terms of both capex investment, but second in terms of bringing consumption back. The two most notable ones being in budget, putting more money in the hands of people through the tax break, and of course GST. The hope is that by the time we see Q3 earnings, there will be some turnaround and uptick in consumption, and that will start to build out some momentum. So domestically, you've seen a slowdown. Um, Hopefully, Q2 is the bottom of it. And I truly believe that if there is one driver of market returns, it is earnings growth. So for the market to re-rate and move meaningfully up from here, you do need a little bit of an earnings catalyst. The second issue is global. And of course, nobody knows what Mr. Trump is going to tweet the next day. But the fact is, tariffs have come as a surprise, given that for 25 years we felt that India and US have had a reasonably strong relationship. Now, a lot has been said about tariffs, but my learning from this whole exercise is finally all of this is a negotiation. And in the old days, negotiations used to happen behind closed doors. Now they happen to happen on Twitter. It's just a different world order. The good news is one believes that at least the ice has started to thaw. And we are moving in the direction of a trade deal. And we'll see over the next few weeks and months how this plays out. The other good news is that for India, the key affected sectors, IT and pharma, so far will remain unaffected. And then we have a small export basket to the US that is affected. So I think the first half of the year maybe have been the more turbulent half of the year. And if we do start to see some turnaround in earnings and some stability on the Twitter action, we may be in for slightly more calm times ahead.
Radhika, interesting. So you're saying earnings remain the key differentiator. Corporate performance has to, of course, show up in some manner to generate value. Uncertainty will remain, but of course, it becomes slightly more stable. We're in a better situation then.
Yeah.
Two follow-up questions to that, Radhika. One, of course, is for some time there seems to have been a bit of a secular growth across asset classes, and everything seems to be
Yeah.
reasonably going up. How do you see that sort of shaping up from here on? And I'll of course ask you the question after you answer this one, the second question.
I think, in short, investors should tone down return expectations, and this is maybe not what you want to hear, but I think investors should, across the board, tone down return expectations because we're sitting at a point where very little looks cheap. Uh, they should certainly pay attention to asset allocation because in times like this, you just don't know what's going to do well. I mean, we're talking of less inflationary times potentially, but gold is doing extraordinarily well because there's a section of the world that believes perhaps the dollar will not remain the center of the world, and I kind of subscribe to that. But I think in general, you have to be thoughtful about allocating money with a slightly longer term horizon. See, when you're trading at 12, 15, 18 kind of P, it doesn't matter what your time horizon is because you will make money even over a shorter term time horizon. I think it's still valuable to invest. It's just that the time horizons need to be a little more elongated, and your immediate expectation of return, quite frankly, needs to tone down. And it's okay if it tones down because people have made a lot of money over the last 3, 4 years. So I don't know if that's the right answer, but that's certainly my current thinking. You're on mute.
Apologies. So that's an interesting perspective, especially in terms of the fact that toning down of expectation, because for many years we sort of thought that double-digit returns from the
Yeah.
equity market was a given, high double-digit returns actually. And then if you were to look at some specific areas, that number could really look large, right? So that definitely needs to get toned down. I'll step back a bit in the context of the global economy, and you spoke about uncertainty and corporate performance. How does India really stand there? Um, because while we are talking about a connected world, in many ways, India has also even been able to be a bit of a decoupled story as well. What's your sense? I mean, how does India stand in this entire scheme of things?
So, I mean, if you look at India and step back a little, both pre-COVID and post-COVID, at least till 2023, we have been outside the US one of the best performing major stock markets in the world and a reasonably stable currency. And that is because, and sometimes Indians struggle to believe this, over the last 10 years, and especially if you look at the UK, the US, and our own South Asian subcontinent, in some way we've become a beacon of stable growth. And as I said, sometimes Indians who think our life is so chaotic struggle to understand how anyone can see us as a beacon of stable growth. But we have become a beacon of stable growth, and that's led to us being one of the best performing major stock markets. 2024 and 2025, I think, have been a little bit of setbacks because we've seen our own growth and consumption slow down. Now, I think, how does India stand relative to the rest of the world? There's good news and bad news. I think if you look at the India story and you have a 5 to 10 year outlook, I think the fundamental cores of the story remain very, very strong. Uh, the demographics continue to be tremendously in our favor. The magic of entrepreneurship this country has, and I hear a new story every day, I think continue to be in our favor. And finally, I think reforms are working in the direction of what corporate India wants. So I think all of that masala continues to be in our favor. There's a lot of hard work that we have to do on execution. There is a lot of hard work that we have to do on jobs, given that we have this demographics and given that we have AI. So there's a lot of execution India has to do, and execution is hard stuff. But I don't think the long-term story is not intact. The fourth thing that is reasonably intact is, and which now investors give more credence to, is the fact that we have a reasonably Atmanirbhar capital market. So, what has also happened over the last few years is foreign ownership in India has come down meaningfully to about 18%. Domestic ownership is well over 25%, which is why, almost frustratingly so for investors, market falls are neither as sharp as they used to be nor as prolonged as they used to be. I mean, the last major market correction we had, of any market correction we had, was 2015. It was a decade ago. And the last period where you had a prolonged correction and someone had time, serious time to buy, was 2013. So I think we've also got a more resilient capital market. So I think from a medium term point of view, the India opportunity hasn't changed if we can continue to execute right. In the short term, in the context of the world, we are not the cheapest market out there. And there are two sources of market return. One is earnings growth, and the second is multiple re-rating. Now, at 25, 30, 35 multiples, it's unlikely that you can rate significantly further upwards. So, any catalyst, as I said, will have to come from earnings growth.
Interestingly, Radhika, you sort of automatically lead on to the other two perspectives which I want to talk to you about. First, of course, is that earlier in the call when we started off, we spoke about toning down of expectations of returns. And as a addendum to that, from an asset allocation point of view for an investor, do tell us, how do you see fixed income assets and core equity income assets behaving in the medium term at least? What kind of expectation should investors have from there?
Okay, so this is tricky, and I think it is. I think it's very much going to be a year of multiple asset allocation. I mean, I've always been a big advocate of thali investing as an approach, and I think this year will be that. So equities, as I said, if you're asking me how equities are behaving, I mean, it's very difficult to forecast, but after 3, 4 stellar years of equity returns, you're not now sitting on flat 1 year equity returns. If earnings growth is to kick in, this can meaningfully move up and turn into double-digit numbers. If it doesn't kick in, I think you'll struggle to see these numbers move meaningfully. There could be long periods of time correction. I think with fixed income, we are getting to the closer end of the rate cut. And there may be some rate cut, but we're getting to the end of this. So 25 basis points, 50 basis points. I think that's what we have left going. And yields have moved down, which and rates have moved down for fresh investors. I think as far as gold and silver are concerned, I think they continue to remain interesting places to park your money, even though both of them have rallied significantly, but silver has not rallied as much as gold. So I think gold and silver will remain a part of the story. Because one more medium term thesis that we have is that the post World War II world was extremely US centric in nature. And perhaps we will move to an environment where more globally oriented assets, non US, China, ASEAN, will start to play in both in political and economic power, and then it will translate into markets. So, in fact, the best performing asset class over the last year outside of gold has actually been global funds. I mean, I look at some of my smaller global funds and I'm surprised to see that Europe is up 30% and China is up 50%.
It's a very, 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 very interesting point of this conversation. So, again, two things which come out of this. One is your observation on the multi-asset investment strategy, saying you need to have a multi-asset strategy. Of course, you can't really depend on a single asset class, or even two for that matter, to really build a meaningful portfolio. It would need to be multi-asset. The second one you talked about of global investment. So, an interest that we, for example, see, Radhika, is that, and we were talking about this when we were meeting you last week at your office as well, is that affluent investors are increasingly looking at two kind of ideas.
Yeah.
One, of course, is slightly differentiated asset classes than just equity and fixed income. They
Yeah.
want like more comp, slightly more comp sophistication. They are interesting ideas and they're open to try things out. So that's one, which brings me to the conversation around the new asset class that SEBI has introduced. And I know that you've already spoken about that, so but want to hear from you on that. The second, of course, is on this entire thing about global investing, and I would want your views first on this. Like I was mentioning, Indian affluent investors are increasingly choosing to park assets outside of India and many are saying that is for hedging and so on and so forth. But here is this great market which is doing so well, and why should Indians look at global markets to invest in?
So I've always, personally, well before I had anything to do with the mutual fund industry, I guess I started my early career in the US. And at least when I started investing, portfolios in the US were not as home biased as they were in India. So if you were allocating 50% to US equities, you were also allocating 50% abroad, including to emerging markets. Now, in India, of course, and when I came back to India back in 2012, again, before I had anything to do with the mutual fund industry, I started being on the hunt for international funds. And people, AMCs would come to me and be like, international fund? So, hey, nahi. And there were like five international funds out there. So I've always been a believer. In India, we've had a tremendous sense of home bias because investing is more new. Products had been limited for a while, but I think that is changing and should change for evolved investors. It's not the playground for first time investors because I really do believe that until you understand the fundamentals of Indian equity and debt, you should not venture to a global market. But indeed, if you are a sophisticated or moderate investor, building a portfolio that has 10 to 25% global exposure, I think is valuable. Because uh, there are times when India does well and it does terribly and they whine. And now recently they're telling me, Madam, पिछले साल तो China has given 50% return and your India fund has not given return. And I keep trying to tell them that that is exactly the purpose of this, that different markets do well at different points in time because economies just have different realities. The second reason I think people should look at global funds is the stage of economic evolution that India as an economy and capital market is at. Not all themes can be listed in India. For instance, a lot of the new age pharma research that happens just happens in the US. A lot of the great work around semiconductors happens in China, or it happens in Taiwan, or it happens in the US. So you just don't get complete. I mean, our largest exchange is not a listed company in India, right? So you just get a lot more economy representation and theme representation when you invest abroad. And the third reason to invest abroad, of course, could be currency because there is some depreciation effect on the currency. So I think it's a powerful construct. I think investors generally struggle to time it, which is why I think it should be a more static part of the asset allocation. And of course, people will look at different themes at different times, but I do believe the two core themes in the portfolio should be US and China because they are the two major large economies.
And for an investor, when an investor considers this global diversification, for years it were primarily funds, right, Radhika? And you mentioned that there are only so many funds which actually invested. Your funds, obviously, on the top of that order. But what are the other options available? We keep hearing about GIFT. What is GIFT? And tell us a bit about what an investor can do through GIFT.
Yeah, I think gift is going to become an important thing for investors to understand because essentially pre-gift, there were two options. One was to invest in AMCs like us who had funds that were INR funds that invested in feeders of a JP Morgan or anybody else overseas. And they're great products. The problem is there is a limit the Reserve Bank of India has, and most of us can't accept incremental money. So if someone comes to me, as much as they love Edelweiss Greater China Fund, they can't write me a 10 crore check today because I can't accept the money. The other thing is to repatriate money abroad via the liberalized remittance scheme route, which you have, and try and trade stocks on your own, which, as you can imagine, is extremely complex to pick. I mean, many people struggle to have the time to do anything in India, forget picking global stocks. And here is where gift comes in. Now, GIFT is the Gandhinagar International Finance Center, but it's essentially an offshore jurisdiction that has been created in India, in Gandhinagar, as I said, where many of us have set up subsidiaries or branches or companies. And what we're allowed to do is set up US dollar funds in GIFT that you can use to invest abroad. So, for an investor, what could this be? Via LRS, using that $250,000 limit, you send money to a dollar bank account in GIFT. And through our GIFT fund, we'll give you access to some fund abroad. Could be Edelweiss Greater China Fund or any other fund, but the investment would be in dollars. So a couple of GIFT funds are already out there in the market for outbound investment, and I'm sure a lot more will come very, very soon.
So thanks, Sadiq. I think we, for example, offer a few funds from GIFT as well. We've got a large setup in GIFT, and we're seeing a lot of interest in our clients to use GIFT, which obviously now brings me to the other interesting question. I think for years together, funds were the only ways in which wealth got democratized. Frankly, I think it was easy for investing. You could just set up a SIP and those kind of things. And then about 10 years ago, we had this entire promulgation of the PMS regulation. The alternates regulation came up. And that rise, I think, has been moving at a breakneck pace over the last few years.
Yeah.
I would guess what about 20-25% of India's mutual fund industry. That's the size of the alternate industry, more or less. And then that's supposed to be growing at 3-4 times over the coming 5 years. So that industry is growing very fast. But obviously, investors in many ways who at least are first-time investors have wanted to have in some ways chosen to stay away, given that these are complex ideas, the ticket sizes are larger. A lot of people hence have chosen not to. I mean, the SEBI, of course, seems to have taken note of some of this stuff, and they have introduced a new product category. We understand. Do tell us a bit about what are these SIFs? What do they really mean to achieve? And how do you see this opportunity now panning out from here?
So, I mean, I'll start with some initial thoughts, and then, of course, we can build on questions. But I come from the alternatives industry, and I'm actually quite excited to see the moment that we're at. Because to your point, I think the alternatives industry has grown meaningfully in India, and so has the mutual fund industry. But they've been at sort of opposite ends. On one hand, you've had mutual funds, simple, dal chawal, for everyone, start at 100 rupees, very compliant, very restricted investments because it was meant for the aam janta, but also very tax friendly, very trustworthy, very transparent. Mutual funds are all these good things. And then you have, more exotic offerings, less investment restrictions in AIF and PMS. In comes something in the middle called SIF, which I think brings together the best of both worlds in many ways. It gives you a lot of the investment flexibility, and we can talk about this particularly in terms of derivatives that the AIF guys enjoyed. But it does it at a ticket size of 10 lakhs, which means the product becomes accessible to a much wider range of consumers. And it also does it with the tax efficiency that the MF platform is loved for. So one of the common challenges typically on AIF and PMS platforms was, if you were doing a derivatives product on AIF, it was 40% taxed. If you were doing PMS, you were paying short-term capital gains in your own account. Enter SIF, it's mutual fund taxation all over again. So in that sense, I think it's an incredible platform. It's like creating alternative, and our brand is called Altiva because I think it's alternatives light. It's democratizing and gradually introducing alternatives. And it's, this is coincidental, Shavel, but I think it's coming at a time when, to your point, equity returns have been very high, and the next 6 months may not be the easiest ones. The easy fixed income returns have been made, and you might have to do a few other things, use a few other strategies in terms of absolute return generation, and SIFs come at that time.
Radhika, I think so. I guess at least the investment world, of course, is very excited about this new asset class and how it can, like you mentioned, change the way investment is seen in investors who are looking at experiencing a slightly more sophisticated investment class at this point in time. And it's going to be interesting. But From an investor point of view, I mean, apart from the fun of doing something more interesting,
Yeah,
um, you really see this bridging some of the challenges that we discussed earlier in the meeting, especially on the fact that return expectations might be lower, the world could remain slightly more uncertain. Does SIF in some ways try to also solve for those problems?
I think no matter what, and I'm being very frank here, no matter what shiny new car comes to market, whether it's SIF or anything else, no investor should do it for the excitement of doing something exotic because then the asset class is not going to last. SIFs will work and investors should buy SIFs if SIFs can use their inherent flexibility to provide investors either better returns for the same amount of risk or for the same return, significantly lower risk. They have to solve an investor problem. And every time we think about putting our hat together and putting out an SIF, including our first one, which opens soon, our only objective is what are we doing using this new flexibility that SEBI has given us to give you something that you don't have before. So, for instance, we talked about fixed income. Now, rates have come down, fixed income is fully taxed. Can we create a more tax efficient, higher return fixed income solution using some smart derivative strategies? Instead of, the 4 or 5% you're earning post tax, can we try and deliver 8% on a post tax basis? Now, if we can, then I think there is a proposition for the consumer. So I think investors should buy an SIF because there's an SIF in the market. Investors should work with people like yourselves who understand these assets and break down each SIF and say, okay, this is what it can do for me. And yes, maybe this has a place in my portfolio.
I think very pertinent point, Radhika. I think, frankly, when investors are investing, that investment vehicle would need to meet the purpose that the investor is really looking forward to. It should not be just another thing on the sides. It's something that's core. You've put enough effort to understand that this particular vehicle really meets that objective. And in many ways, like you said, I think our advantage is that because we are present as a bank in India, onshore and in Gift City, ability to transfer funds across there, enabling clients to invest course becomes very easy. Thanks for calling that out. I have a question here, Radhika, and because we're talking about SIFs, a very interesting question, and I read it out for you. It says, talking of new asset class with SIFs now demanding high entry thresholds
Yeah.
of 10 lakhs, as 80% of active funds are underperforming the index, and returns on lump sum often beating SIPs. How can SIFs create real alpha versus low cost passive options beyond exclusivity and diversification? And in the same context, how does the industry sustain the allure of SIPs for compounding when lump sum data looks more compelling?
Lump sum data looks more compelling. Okay, so I'll come to the SIP question later. Maybe let's start with the SIF question. I think there are a lot of myths on what SIFs are and what SIFs are not, including the biggest myth, which I would want to take a moment to use this question to address, that SIFs are very high return vehicles. There's lots of stuff on TV going out and saying, oh, SIF is going to give me higher alpha than my mutual fund, etc., etc. What are SIFs allowing you to do? At heart, SIFs are giving you more flexibility to use derivatives. In a mutual fund, I could use derivatives. There are arbitrage funds. But if I bought 100 rupees of stock A, I had to short only 50 rupees. If I bought 50 rupees of stock A, I could short 50 rupees of stock A. In SIF, I can buy 50 rupees of stock A, but short 25 rupees of stock B. It's the first time I can profiteer from the fact that a stock or asset or market is falling. This is the new flexibility coming your way in SIF. Now, this flexibility, SIFs don't allow you to take large amounts of leverage. In fact, they are now no leverage. So they're not designed as a higher return vehicle, contrary to expectations. They're actually meant to cut risk. The use of derivatives in SIF is actually going to lead to lower volatility solutions. So hybrid like products with maybe lower volatility than a PAF. Fixed income like products with maybe higher returns or similar returns as equity savings fund, but with one third the risk. So SIFs are risk adjusted products. I don't think they will take the place of traditional active funds, passive funds, which are pure long only products. I think long short products have a very different kind of space. And if someone is just using the SIF platform to manufacture what is on the mutual fund platform, why should an investor be able to do something he could not do on the MF side?
So,
So
so, so
that's my take.
Interesting. So basically, you're saying we should not equate it with higher returns. It's primarily a risk management tool, and it is people should obviously not view it as somebody which can take incremental risk to generate incremental returns. It's slightly different by objective. And because you spoke about risk, um, give us a bit more of detail on the context of risk on SIFs, and is it a significantly higher risk that the investor is really getting into, or within the multiple parameters of SIF, are there controls already built in?
Okay, so I think the questions you need to ask when you look at an SIF document is a few. What is the net amount of market exposure that the SIF is taking? You will see SIFs which have zero exposure to market, and you will see SIFs that have 75 exposure to market. You can't have an SIF which has 110 exposure to market, which is my point around risk. Second, you should see the standard deviation and the worst case outcomes the SIF will deliver. Third, you should see the statistics. I would ask a new SIF manager for as an investor, is it statistics? I would ask a new SIF manager for as an investor. These are three statistics. Now, there are different categories of SIF SEBI has put out there. There is an equity category, there is a hybrid category, there is a debt category. The equity category, in my view, will be a lot of solutions, which, and I don't want to broad base, but will generally hold 40 to 60% long equity, maybe 20% short equity, and try and build a solution that tries to mirror equity returns, but with less fluctuation. That's what the equity category, I think, will try to deliver. The hybrid category is going to give you fixed income plus solution. So it's going to say, like, we're launching a fund, Altiva Hybrid Long Short SIF, where part of the money goes to fixed income, part of it goes to arbitrage, and a little bit goes into simple derivative and special situation strategies. So instead of earning 6% in fixed income, you're trying to earn 9 to 10% in a very tax efficient way. So that's one solution. The fixed income ones will try to do credit, REIT, InvIT. So one, two SIFs are not going to be the same. Even two SIFs within the same category are not going to be the same, which is why I made the point of going back to people like you guys who actually understand what's going on. Because if I take equity long short as a category, someone can run an SIF with 75 long, 25 short, and someone can run one with 20 long, 20 short. Now, do they look like the same product? They're not the same product.
So you may be in the same category by definition of SEBI, but may actually run completely different products, completely different risk profiles, and of course outcomes may look very, very different. So again, interesting. So our customers who are watching this must really be careful when you choose one. You must of course evaluate, but when you do, please be conscious of the details of the product. A categorization, unlike in funds where
Yeah.
it is slightly more straight jacketed, in
Yes.
here, it may look very different from each other. I have a few more questions, Radhika, on SIF. Already 4 or 5 questions on board. First one, how is SIF different from hedge funds?
SIF is hedge fund light, in simple terms. The big difference is, so hedge funds can use derivatives the way SIF allows. Hedge funds can hold a much wider range of asset classes, a lot of fancy fixed income, mortgages, etc., stuff that doesn't exist in India's capital markets. And most importantly, hedge funds can take leverage. So with 100 rupees of exposure, with 100 rupees of capital, you can get 200, 300, 400 rupees of exposure. You can also lose that much money. SIFs do not allow you to take leverage. So they are hedge fund very light.
Hedge fund very light. That's a good example. Good nomenclature to use. I have a question which says, can we do multiple SIF strategies with a 10 lakh investment?
Yeah, you can. In fact, what you can do is the 10 lakh investment is actually at AMC level. So if Altiva runs 4 SIFs. You can put 2.5 lakh, 2.5 lakhs each into each SIF. And if you are at 10 lakhs at the Altiva level, then you're good. Now, this will start making sense once an AMC has multiple different SIFs under its umbrella. Right now, everyone's launching one.
So it's a at an investor and a AMC level.
It's investor
That,
time.
oh, interesting. So you can do multiples.
Yeah, so it's going to make this very accessible eventually. But
Very
I
accessible.
say
Yeah.
one thing, like, don't go hunting for an AMC just because it has 4 SIFs so that your minimum is lower. Focus on the quality of the product. And if you're stretching to hit 10 lakhs, maybe SIF is not for you right now, Any.
That again, that's a simple advice, but very apt in the current environment. Within the asset management industry, of course, we are aware that a number of asset managers are now entering this fray. Do
Yeah.
you see this becoming like the mutual fund industry, where so many asset managers had come, a lot of funds came in, regulations came in after that? Do you see that kind of a momentum building up, or how do you see the industry itself sort of building up from here?
I mean, candidly, I think it's an exciting moment. But SIFs require a different kind of capability. So, and people will only or should only launch when they have the capability. Now, the mutual fund industry went from 10 to 30 to 50 players. I think it's going to have 100 players by the end of the decade. I don't think the SIF industry will have 100 players, but I think you'll have a fair number of them. What I do already see is a lot of Cat 3 AIFers and PMSers now rushing to take mutual fund licenses. But I think in this industry, track record and product construct will really be the differentiator. I do think, as I see my business purely as a head of business at 2030, 80% of what I'm going to be doing is still mutual funds, because the core, and this is probably going to be true of your wallet as a consumer, guys. 80% of that wallet will still be occupied by our Dal Chawal mutual funds, but things like GIFT and SAFE and international funds could be the balance 20%. So it's an opportunity for asset managers to flex, to show different kinds of capabilities, to stretch themselves a little. But they are targeted niche solutions. I don't think you'll see 1 lakh crore individual SIFs in size, just because the derivative exposure will not allow you to absorb that size today.
Super. Sure. Portfolio construction, I think one of the questions that we always sort of struggle to, in fact, because we believe very strongly in the idea of asset allocation, is when such new asset classes come, and also when we spoke about global investing, I think this idea becomes far more real than it was, let's say, 5 years ago. How do you think a client should, an investor should think about asset allocation, given these two specific elements in the portfolio?
So I think with global, you have to think about it as a static part of your thali. Now, whether it's 10, 15, or 20%, I think your advisor, wealth manager is going to be the right person to guide, and you'll scale it up. With SIFs, SIFs in themselves are not an asset class. SIFs are tools to find a solution. Now, you will have to evaluate each individual SIF and see if it meets a need in your portfolio. So if there's an SIF and you have an equity allocation, but you feel through an SIF, you can get the same equity allocation with lower risk, then maybe it fits in your equity bucket. Or if you can get a better debt allocation through SIFs, you'll fit that in your bucket. So with SIFs, I think you'll really look at it and say, "Acha, ye problem solve karta hai, and now let me see if that's a need I have." So you see the need the SIF solves, and then do you need it? See the problem the SIF is solving and say, "Oh, is this something I need?"
Interesting. So you're saying that global investment is a given. As to
Yeah.
what percentage would be 10, 15, whatever you would decide, because that really has a specific purpose that it meets in your portfolio. SIF, on the other hand, is the other way around. You look at your portfolio and decide if there is a problem in the portfolio, the SIF could be able to solve it for you. And that is how you should really allocate to SIF. It should not be like a thing to do, say 20% should be SIF. It's more
Yeah.
about saying, is there something that I should address?
Yeah.
Interesting. Interesting. Since we're talking about portfolios and Radhika, long-term portfolios, and again, I'm talking from the context of our own customers, Radhika. We, of course, a majority of our customers are really strategic investors. They're investing for meeting a long-term goal, and obviously, they look at from us. They expect us to provide them portfolio which is stable and sustainable over a period of time. If as an investor, Radhika, how do you sort of plan your long-term investment? What kind of asset allocation do you do?
Oh, I mean, I'm a reasonably long-term investor, and I'm actually a very good consumer for anyone because I don't review my portfolio that frequently. Uh, I actually only look at the numbers once a quarter, and I make small changes once a year and real changes once every 3, 4 years. So I'm probably a very nice consumer for everyone. Um, I have a very 80-20 approach. So the 80% is core long-term needs. The 20% is a lot of tactical stuff, which is mostly my startup investments. So the 80% is mutual funds and the 20% is startup. So you can see the binariness. I think the asset allocation is a function of circumstances and goals. I mean, I remember when I was an earlier, younger entrepreneur with a home loan and all of that, I think I was a lot more conservative in my investments. So you saw much more of a 50-50 kind of allocation, a lot of hybrid funds used to implement the kind of allocation I did. I've always believed in, because I'm salaried, in doing very large SIPs. So one of the things I religiously do is increase the size of my SIP book after compensation is reset every year. Now, as I've completed life goals, house, etc., and I'm looking to longer term goals, kids' education, retirement, and I'm in a different financial place, my asset allocation has become more aggressive because my needs are that. So now it's a lot more equity biased than it used to be before. But again, SIP remains a very powerful part of approach. I have gold and silver, I have international funds, and then I have the usual stuff. So that's really what it is. But
Radhika, this sounds slightly contrarian because we get to be, I mean, the traditional way of thinking is that when you're younger, you can take more risk, so you should
uh,
do more equity. As you get older, possibly you should reallocate. So why this contrarian approach? Why would you have chosen to be slightly more aggressive as you grow older?
because I don't believe in, I've heard this young person theory. I don't believe age is a determinant of risk appetite. I believe risk appetite comes from context. Now, when I was a 30-year-old entrepreneur, and remember, my husband is a capital markets professional. So we are both naturally very high risk people in our professions, and our professions are highly correlated to the stock market. So the year markets do well, you can imagine, is a great year for me, times two. Uh, because the funds do well, the AMC's revenues are higher, my bonuses are better, my ESOPs are better, like everything looks great. And then the year you have a bad year, everything doesn't look so great. So my context is very, very unique. And when you have liabilities, when you have home loans, until you have that security, I've always felt it's better to be conservative. I think I've met, by the way, Shaval, 80-year-olds who are very aggressive. Like I'll tell you, my father, he's more aggressive in risk appetite than me, and he's 75. Now, this is very contra to what you're saying. But think about him. He has a pension. He has a wife that works. He has 4 kids, all of whom work. He has a fully paid up home. He's chilling. So he's a small cap and micro cap investor. Um, and quite frankly, he has the time to do it and it works for him. So I really think risk appetite is very contextual, not age dependent.
I think that's a great perspective, and again, this is something that we keep facing when we engage with our clients. And I think this is a great message saying any kind of investment decision is a personal is a reflection of the personal situation you are in. It is
Yeah.
not really a thumb rule which you can apply for everything. You need to really look at where you are. Obviously, consult a financial advisor who can then sort of guide you through that decision. Um, I, I've got two more questions, Radhika. One, of course, is when you look at young investors now, because again, from our customers, there's a large part of customers who are really starting their career in some manner, first corporate jobs, are doing very, very well, obviously multiplying their income. At that end, the kind of growth that we are seeing in India. Um, what would your advice be to them on their investment journey?
For young people, I have very simple advice. Uh, I know you're in the early days of your journey. I know there's all this stuff like YOLO going on, and you have to go to the next Coldplay concert and all the fun stuff that happens in life. Shebel is too old for it, but I actually know what it is. Uh, but I think it's important to start habits when you're young. Um, and I always tell young investors, get into the habit of building a post-tax investment portfolio every month. So whatever your income is, build up targets on what your post-tax investment is and set that up as discipline and start the journey as early as you can. If you're sensible enough to engage an advisor early, that is incredible because you'll make less mistakes. So I highly recommend that. But for young investors, all I recommend is habit.
Awesome. So build a investing habit. Don't worry too much about allocation and all that. That over a period of time you will learn. But
Learn.
great. Right. Now to our more affluent and sophisticated investors, the investors who of course have built a reasonable amount of wealth, are perhaps replicating the kind of financial situation you would be in, but not necessarily very savvy or have time for taking very deep financial decisions all the time. For them, how should they shape their investment strategy? What should their allocations look like?
So I think there, no help really comes in handy. Honestly, as I said, with young people, if you can get help, it's okay. But I think as you turn to your 40s, the importance of personal context is very, very high, and circumstances. And I think you really have to think if you're 40, 45, what one money means to you and what you want to achieve with it, because that will help you set out time horizons and goals. You could have foreign education goals that consume a large amount of money. You could have early retirement goals. And then you really need to start mapping money to goals and outcomes. And that's where the advisor relationship comes in. A lot of people are India educated professionals who've done extremely well, who want their kids to have a foreign education. That's just an expensive proposition. And I think that's something that needs to be planned out. So I think at that life stage, mapping money to real goals and aspirations and thinking deeply about them is very important. The second thing I think at that stage is by then you have understood what scares you and what risk you can take. You are a veteran, as I said, amusement park visitor who knows, can I deal with the roller coaster or do I just need to be on the merry-go-round? You know where you are. By then you've understood yourself, not in your 20s. And I think any asset allocation decision, Cheval, has to be one that obviously doesn't waste money by keeping it in an idle account, but lets you sleep easy at night. For instance, I made a call that I would build a portfolio that would not let me feel uneasy in a market correction when my profession is already under stress. I don't want to ever be in a situation, and I've made this mistake before, where I'm professionally under stress because of market circumstances and the kind of stress and all that we carry. And my personal portfolio is a source of stress. So it was a very, very conscious call. And I think at that stage, those are the kind of things that you want to start thinking about. I think you also need to think about how much liquidity is important in your portfolio. I think with HNIs, there is sometimes they move away from the simplicity curve because they have access to so many different and interesting things. And I do think simplicity is very powerful, and I think liquidity is incredibly powerful. So having guardrails as to how much exotic I'll do, how much illiquid I'll do, I think guardrails are very powerful. So I have very strong guardrails. How much is ESOP wealth going to be a part of my net worth, etc. I think those are the kind of things you need to think about.
Superb, Radhika. And I would want to paraphrase the conversation till now. You saying that markets would have always been uncertain. This just might be one phase where it's slightly more uncertain than
Yeah.
some earlier phase. Two, you saying that investors have got used to a certain amount of return that may not be a fair, real expectation from here on. Three, you said a multi-asset portfolio is what should eventually aim for. Obviously, what percentage allocation is a function of individual position. It's not something that you can define. You spoke about how individual investors should behave. I think that far end of this conversation, that investing behavior is the important part. We should not get too carried away with where I'm investing to begin with. And the second one is exactly the opposite, where you build the investment behavior, but then now you need to know where you want to invest and why. It needs to be completely goal based. And you've been reiterating the requirement for a plan or a guide to be able to take you through. So these are the core things, and specifically on global investing, your advice, there needs to be definitely a portion of your portfolio into global investing. Gift a great route to achieve that. SIF, it is not another thing that you should be invested in. It needs to serve some purpose in your overall core portfolio to be able to really find your money. But exciting times, new ideas coming through. Great. I think it has been absolutely fantastic to be able to speak to you, Radhika, today. I mean, every time we speak, it's a great experience, and really appreciate. We look forward to the launch of Altiva, and we of course would obviously be in a position to offer them to our clients as well. Any last words over the weekend, Radhika? What's your plan? What do you want to do over the weekend? Which book are you reading?
I want to play with my 3-year-old over the weekend. I don't read finance books these days. I write them sometimes. So,
Yeah,
Mango Millionaires on the shelves and doing well, but uh, money finally serves a purpose. I mean, we've had a long conversation about money, but it serves a purpose, and that's to lead a richer and happier life. So I want to go shopping. I want to take my kiddo out, open a nice bottle of wine, and enjoy chocolate cake because it's been a little bit of a crazy week. And I think really investors, finally, money is a goal to lead a happier, richer, better life. Finally, an NAV can't give you happiness here. And
super, Radhika. On that. Sorry, you saying something? My
I'm
apology.
saying I'm a mutual fund CEO and I'm telling you an NAV cannot give you happiness.
Fascinating. I mean, fascinating live view. Thank you, Radhika. Do have a great weekend ahead, and we
Mhm.
look forward to catching up with you again. To our viewers, as you can see, this is a fascinating opportunity that's building up in India. Do reach out to us. Do reach out to your financial planner to help you through this journey. We are available to you 24/7. And with that, I bring this edition of Navigate with HSBC to a close. Looking forward to the next one. Looking forward to engaging with you again. Thanks a lot, Radhika, for your time this evening. Bye bye.
Thank you.